It was not in the headline. It was not in the analyst summary. It was buried on page 47 of a quarterly fund flow report that almost nobody reads. A single table, 3 columns of data. And inside those numbers, a pattern that Michael Burry recognized immediately because he had seen it before. Not in the same document, not in the same market, but in the same shape, the same rhythm, the same warning. Burry cross-referenced that table with 2 other public data sources. He ran the calculation the table implied but never stated directly, and what he found is the reason he now describes a specific convergence of signals as the most reliable crash indicator he has ever identified. Today, we examine those signals the way Burry would. We follow the data from the document to the pattern to the conclusion. And by the end of this video, you will understand why Burry believes most investors are watching the wrong indicators entirely. Michael Burry is not a market commentator. He is not a perma-bear who predicts collapse every year, hoping to eventually be right. He is a former medical doctor who built one of the most precise records of systemic risk identification in modern financial history. In 2005, while every major investment bank was packaging mortgage securities and calling them safe, Burry was reading the actual loan documents, page by page, clause by clause. He found what nobody else was looking for because nobody else was reading. His conclusion: the American housing market was built on structural fragility, and it would collapse. 2 years later, his fund generated returns of 489%, while the global financial system buckled. Burry does not guess. He does not speculate. He reads. And right now, what Burry is reading points to a specific set of signals he has identified as precursors to violent market dislocations. That record of precision is exactly why his current analysis demands serious attention. To understand what Burry is tracking, you need to understand how modern markets have changed. Before the era of passive investing, markets operated through a process called price discovery. Individual investors, fund managers, and analysts would evaluate companies independently, form judgments about their value, and buy or sell accordingly. This collective process of disagreement and evaluation is what kept markets rational. That mechanism has been fundamentally altered. Today, passive index funds control more than 50% of all equity fund assets in the United States. That number was below 10% in 2003. The implication is significant. When more than half of all equity capital flows, not according to independent judgment, but according to index membership, the prices of individual stocks become increasingly disconnected from their actual business fundamentals. Burry has argued that this disconnect is not abstract. It is structural. It has a measurable shape. And structural disconnects do not correct gently. They compress tension across the entire market until something breaks. Burry's core argument about crash signals is precise. He contends that most investors monitor price-based indicators, market valuations, technical chart patterns, momentum signals. These indicators exist, and they matter. But Burry's research points to a deeper layer. He argues that the true crash signal is not visible in price itself. It is visible in the behavioral and structural conditions that precede price collapse. According to Burry, when passive fund concentration reaches extremes, when credit markets begin to diverge from equity markets, and when liquidity conditions in the underlying stocks of major indices begin to deteriorate, you are not watching a crash happen. You are watching the conditions that make a crash mathematically inevitable. In Burry's framework, by the time price confirms the signal, the opportunity to prepare has already passed. The signal comes before the price, and most investors never look where the signal actually lives. The first signal Burry has identified is passive concentration extremes. As Burry argued in 2019, when passive vehicles grow large enough to dominate trading volume, The stocks inside the major indices begin to trade as a single correlated asset rather than as individual companies. The average correlation between individual S&P 500 components has risen significantly over the past 2 decades. In the 1990s, that correlation averaged roughly 25%. In the years following the passive investing explosion, it rose well above 40% during periods of market stress. What this means in Burry's analytical framework is that price signals within the index have become less meaningful as measures of individual company value. A stock rising does not necessarily mean the market believes in that company's future. It may simply mean passive flows are mechanically purchasing the index. A stock holding steady does not mean it is valued correctly. It may mean passive capital is maintaining an artificial price floor. Burry's point is that when correlation is high and passive dominates, the index acts like a compressed spring. When selling begins, it does not differentiate. Everything sells simultaneously. There is no natural buyer at current prices because the buyers were not buying on fundamental conviction. They were buying because the index demanded it. That is not a market. According to Burry, that is a mechanism waiting to reverse. The second signal is credit market divergence. Burry has consistently directed analytical attention toward credit markets as the honest signal that equity markets frequently ignore. Credit analysts, unlike equity investors, must evaluate the actual ability of a company to repay debt. The numbers must work, or the loan does not get made. Sentiment cannot override arithmetic in credit markets the way it can in equity markets. Burry has pointed to historical instances where high-yield credit spreads began widening before equity markets acknowledged any problem. In 2007, high-yield spreads began moving in the summer. The equity market peaked in October. The gap between those two signals represented in Burry's framework the window in which informed positioning was still possible. Any significant divergence between high-yield credit spreads and equity market valuations is, according to Burry, the most reliable early warning system available to an investor who is paying attention to both data sets simultaneously. Most retail investors watch equity prices. Almost none watch credit spreads. That asymmetry between what is watched and what is honest is precisely where Burry believes the structural advantage for independent analysis lives. The third signal is what Burry has called the liquidity illusion. This is perhaps his most important and most widely misunderstood argument. Index funds trade as perfectly liquid instruments. You can buy or sell a share of a major ETF in milliseconds at the quoted price. The fund appears infinitely accessible, but the fund is not its underlying components. The individual stocks inside major indices, particularly the smaller and mid-size components, do not trade at the same volume or depth as the ETF itself. Burry has used a precise analogy to describe this structural problem. He compared it to a theater with a single exit door. On any regular afternoon, the theater functions normally. People enter and leave without difficulty. But if everyone in the theater decides to leave simultaneously, the single door cannot absorb the flow. The ETF can be sold instantly. The stocks inside it cannot be sold at the same depth simultaneously without catastrophic price impact. When redemptions accelerate, fund managers must sell underlying holdings. If those holdings are thinly traded, the act of selling creates price collapse before the average investor has even processed what is happening. Burry documented this specific mechanism in his 2019 analysis of passive vehicles, drawing a structural parallel to the collateralized debt obligations he had analyzed before 2008. The shape was identical, apparent liquidity concealing structural fragility. The fourth signal Burry tracks is margin debt behavior. When investors borrow heavily to buy equities, they are making an implicit wager that prices will rise faster than the cost of their debt. When that assumption breaks, the dynamics become violent and self-reinforcing. Margin calls do not consider fundamentals. They respond to current prices versus collateral thresholds. When prices fall, margin calls are triggered. To meet them, investors must sell. Selling drives prices lower. Lower prices trigger additional margin calls. Burry has studied the margin debt cycles preceding the peaks of 1999, 2007, and 2021. In each case, margin debt as a percentage of gross domestic product reached historical extremes within months of a major market peak. The build-up was gradual over many years. The unwind was not gradual at all. According to Burry's framework, the direction and rate of change of margin debt levels is a more reliable leading signal than most investors recognize, precisely because it is not measuring sentiment. It is measuring leverage. And leverage, once it begins unwinding at scale, is self-reinforcing on the way down, in a manner that no sentiment indicator can capture. The fifth signal is retail behavioral reversal. Burry has observed that retail investors learn heavily from the recent past. A market that has punished every seller and rewarded every buyer for a decade creates a population of investors conditioned to buy weakness without evaluating underlying market structure. This conditioning is not random. It is the product of a specific monetary environment, low interest rates, persistent central bank intervention, and the implicit backstop of quantitative easing programs. When that monetary environment changes, the learned behavior becomes dangerous. Investors continue purchasing dips in a market that is no longer supported by the same structural tailwinds that validated the strategy. The dips get deeper, the recoveries get slower, and the moment retail investors collectively recognize that the old pattern has broken, that recognition accelerates the very process that Burry's earlier signals had been documenting for months. According to Burry's analytical framework, retail capitulation is not the beginning of a crash. It is the confirmation of a structural unwinding that began much earlier in the credit and liquidity data that nobody was reading. Burry himself has been explicit that his methodology is not designed for passive observation. It is designed to inform action. Applying Burry's framework to your own analysis begins with a fundamental shift in what you monitor. The first change Burry's research demands is redirecting your attention from price to structure. Price tells you what has already happened. Structure tells you what is building underneath. Before evaluating whether a market is expensive or cheap by traditional valuation metrics, Burry would ask you to examine the liquidity conditions of the underlying assets in your portfolio, the current direction of credit spreads, and the concentration of passive capital flows into the positions you hold. These are not exotic calculations. They are publicly available data. The Federal Reserve publishes margin and flow statistics. Credit spread data is freely accessible through multiple financial platforms. Fund flow reports are available from Morningstar and the Investment Company Institute at no cost. Burry reads them routinely. The information is not hidden. The gap is in the habit of reading it at all. The second change. Burry's framework demands is stress testing your exit rather than your entry. Most investors evaluate an investment by asking whether it will rise. Burry evaluates an investment by modeling what happens to his exit when everyone else needs to exit simultaneously. This is not pessimism. It is risk accounting applied honestly. If your portfolio consists primarily of positions inside large passive index vehicles, Burry's question would be direct. What is the actual trading liquidity of the underlying components? What happens to your execution price if 10% of passive holders redeem in the same week? If the answer to that stress test produces a loss you cannot survive, then in Burry's framework, the position carries substantially more risk than current market prices are reflecting. The price looks safe. The structure does not. The third principle Burry embodies is patience under conviction. In 2007, Burry held his positions through extraordinary pressure. Investors demanded redemption. His prime broker restricted his trading. Every institution on Wall Street told him he was wrong. His signals told him the structure was broken. The market had not yet confirmed it. His discipline was to trust the structural data over the consensus price. For any investor applying Burry's framework, this is perhaps the most difficult lesson. The signals he identifies do not carry a specific timeline. They document conditions. Conditions can persist far longer than any model anticipates before they resolve. But when they resolve, the resolution is rapid. The investors who prepared before price confirmation had the opportunity to position carefully. Those who waited for price to confirm the signal, as Burry has noted, are already late. Today we examined Michael Burry's framework for identifying crash signals that most investors never locate because they are not looking in the right places. We traced 5 distinct indicators through his documented analytical lens: passive concentration extremes, credit market divergence, the liquidity illusion inside index vehicles, margin debt dynamics, and retail behavioral reversal. What Burry's body of work demonstrates is not that a crash is inevitable on any specific calendar date. It is that the conditions preceding crashes have a recognizable and measurable shape. That shape is visible in the structural data before it becomes visible in price. Burry identified that same shape in the mortgage market in 2005. The broader market did not see it until 2008. That 3-year gap between when the structure signaled and when price confirmed is the entire argument. The signal is in the data. The data is public. The question Burry's research leaves every investor with is not whether they believe in the analysis. The question is whether they are actually reading the documents that contain the answer. Thank you for watching.